In July, the American labor market reached a sudden point of friction. Employers cut 23,000 jobs, a sharp deceleration for an economy that had maintained steady growth for months. This isn't a simple one-month anomaly. The Bureau of Labor Statistics is revealing a deeper trend through its recent historical corrections. This chart shows last quarter's employment data. Revisions erased 103,000 jobs from the prior 2 months, turning growth into a deficit. Contradictorily, even as job bars plummet, the official unemployment rate dipped to 4.1%. That low unemployment rate suggests stability, but the underlying data reveals a different reality. The high-intensity hiring period following the pandemic is visibly losing its momentum. The numbers are undeniable, but they force us to look for the specific force that is actively dragging the job market down. That force is being generated right here. The Federal Reserve is the primary architect of this widespread economic cooldown. The central bank has prioritized one goal above all others, using every tool at its disposal to pull high inflation back down to earth. Federal Reserve Governor Lisa Cook recently reinforced this stance, signaling a willingness to keep raising interest rates if inflation remains stubborn. We can visualize this mechanism as a heavy weight labeled interest rates, pressing down on capital flow. When rates rise, borrowing becomes significantly more expensive, choking expansion. Factories are paused, storefronts unbuilt. This lack of expansion forces companies into hiring freezes and active layoffs. These job losses aren't an accident. They are the mechanical, intended byproduct of a central bank policy designed to slow the economy down. The gravity of the Fed's high interest rates is so pervasive that it can easily overpower massive, isolated bursts of capital entering the market. We can see this in the recent $100 billion tariff refund that was initiated by the Trump administration. The Supreme Court struck those tariffs down, which forced that massive sum of cash back into the private sector. In a typical economic environment, a sudden $100 billion injection would act as a massive stimulant for hiring and corporate growth. But today, that capital is failing to spark a turnaround. A single cash infusion cannot negate the systemic, daily pressure of high borrowing costs. Even billion-dollar legal and political windfalls are being suffocated by the Fed's relentless pressure on the economic brakes. This dashboard juxtaposes the red job loss columns against the high interest rate line. It shows 23,000 jobs lost in July, alongside 100,000 negative revisions. For the Federal Reserve, this is exactly the outcome they engineered, trading labor market strength for lower inflation. The job market is currently defined by this tension and precarity, as companies struggle to balance their payrolls against the cost of debt. To find the path forward, look past the monthly job headlines and start watching the core inflation reports instead. If those reports show that inflation is not easing, the Federal Reserve will likely tighten its grip even further. The current job market cooldown represents a deliberate, engineered slowdown, one that